Excellent. I think now we are recording. So, John, if you want to start, it's all yours.
All right, thank you, Pancho. Good morning, everybody. Welcome to the Three Amigos talking about marketing stuff. So here's the deal with cotton. The blue line there is the December 22 current crop harvest time futures price, and it's lower than it's been. And the next year's the December 23 is lower still. Now this goes back to January. If I went back to 2019, it would remind us that we started from a really low spot below 50 cents. We've had an incredible climb up to the market highs of, with this contract, was $1.32, and in the December 21 it got to $1.50, an incredible rally, historically high prices. And then we had this big tumble in May, and that was probably due to demand fears of recession. That partially explains it. I can't fully explain it. This was an incredible drop, especially given the fact that we had the worst drought in history out there. Why the market would be going down so much is a little beyond me. And then in August, they cut 3 million bales out of the U.S. crop size, which the fact that they cut it wasn't a surprise, but how much they cut it was. So that kind of gave us a rally again back up to over a dollar, about $1.16 something. And since then, we've been back in another recessionary fear slide. The stock markets are lower because of it. Oil's lower because of it. Grains are not as bad as cotton, but a lot of commodities are lower, and we've been taking us down back under $1, and in this case back under 80 cents. So quite a ride. Let's focus on some of the reasons, and the reason basically, as you might have guessed by this up and down and up and down, we're in kind of a tug of war. That's why I've got this balance here, but we're in a tug of war between a tight supply picture, which is what I've got circled here in the balance sheet. This is the current crop that's out there in the field right now. The market, the futures price is reflecting the current crop that's out there. And we're in a situation of uncertain and tight supply, again, because we're in a drought situation. It's been a tough year. It's not over. There's a hurricane about to wax, the South Georgia. So it's kind of a mess. It's kind of uncertain. They've been doing a lot. This number here has been what's been changing. Like I say, in August, they whacked 3 million bales off of this number, which for a monthly adjustment is kind of huge, kind of historically large. And then earlier this month in September, they went back and added a 1.125 million bales back to that estimate, based on new data. And the new data that they were using they got FSA certified acres data, which they'll probably get more of that this fall or winter. And that suggested that the crop was bigger just because the planted acres were bigger. They have Jennings data that's coming in, and they have survey data that they're surveying growers through email or through mail, through phones. They're also going out in the fields in selected cotton growing states, Texas being one, and taking field samples and counting bolls. And they're going to do that they did it in September. They're going to do it in October, November, December. And so you might expect the combination of that field sampling, that farmer surveying, the Jenner's data, and any other certified acres data that comes in. All of that is going to help refine the picture. And I have historical evidence of that refining process across the fall months here. You can see that the percent of the guesstimate of the production narrows into very closely to the actual estimate. That's what this is basically showing, that the guesstimates are getting tighter and tighter and tighter and tighter as we move through the fall because we got more data coming in. So we'll continue to have that data coming in, and this production estimate is going to get more and more refined as the months go by. And as that happens, it's going to take a little bit out of the market, out of the price, because there's an uncertainty premium built into this number, and that uncertainty is fading as we get more data. So that's the supply picture. It's tight. It may get tighter, but it'll get clearer. And then we've got the demand picture, which here's exports. This is what we mostly do to our cotton, over 12.5 million bales exported. You know, if supply is higher, we'll export more. If supplies are less, we'll export less. That little number there, 2.3 million, is how much is spun into yarn over in the Carolinas and Georgia and Alabama, places like that. And the most important number is the bottom line number, which here it's reflected as millions of bales of ending stocks, the leftovers number. As that number gets tighter, prices go higher. As this number is larger, it's a little heavier and prices go lower. It's been tightening. This number's been tightening. It's tighter and lower than it was in previous couple of years. So that kind of explains why prices are higher in this marketing year compared to this. So we'll just have to see what all these moving parts and all these changes do to that bottom line number. But where we're at, looking forward, looking at next year, first of all, I don't have a drought map or La Nina business in my presentation. Mark may have it in his, but basically this drought is being caused by a La Nina condition. The La Nina condition is forecasted to last through the winter, at least into the first quarter of next year. That suggests we're going to have a dry winter across Texas. That suggests that next year's crop may also suffer a bit from high abandonment, at least abandonment of early planted stuff, and dryness and tightness. So that's going to be an issue. I'm also kind of looking at fewer acres planted next year. So the combination of fewer acres planted and, you know, high abandonment means that we may have really tight supplies next year. So that may or may not be offset by recession and shrinking demand. So we'll just kind of have to see. But I think the high prices and the uncertainty of the supply and demand picture is going to carry right on through the winter into next year, and that may hold prices higher. This is what I'm basing my prediction of fewer planted acres. This is U.S. planted acres in millions over here. So in 2022, we planted a little over 12 million acres right there. Down here, I've got the ratio, the relationship between new crop corn prices. That's December 23 futures and December 23 ICE cotton. This is what it was as of this morning. You know, a little over $6 per bushel corn and 77-cent cotton. If you divide that number by that number, you come up with a number on this scale way over here to the right, because that's a historically high ratio. It is basically saying that corn prices are relatively higher than cotton prices, and that feed grains, and by extension soybeans and maybe even peanuts, may attract acres away from a relatively low priced cotton. So that being the case, historically, where that ratio is right now, it's 7.9. It would suggest that, man, we may plant well under 10 million acres. We may plant something closer to 9 million acres, and that's, you know, that's a big cut. We won't feel that in Texas as much as they'll feel it over in the Delta and the Southeast, but nationwide, it'll be fewer acres. And if we have dry conditions on top of fewer planted acres, it could be pretty dang tight. So anyway, what our clients, our farmers, and what we as cotton market watchers should be doing is looking at the first indicators of how big or how tight the supply is going to be. So people next January will be giving outlook. I'll be giving outlook. A lot of people at the Beltwide Conference in New Orleans will be giving outlook, and that'll be making the news. So the predictions of planted acres are going to be closely watched and repeated and reacted to. National Cotton Council does their acreage survey in February. USDA does theirs in February, and USDA does another one at the end of March. And the market's going to be anticipating and reacting to all those things. And so our growers should too. You know, those reports can be anticipated. So I'll skip that and just get back down to here. I'll still be on the call if anybody has any questions. So I'm going to hand it back to you, Pancho.
Thank you, John. Great presentation. Hey, anybody has any questions for John now? Mark, if you want to put your slides and start your presentation.
All right. I think Should have everything unmuted, and hope you can see that on the screen. Jump in, Pancho, if there's a problem with that presentation. Thanks for guiding us through this, and good to be with y'all here this morning. I'm going to touch a lot of the same things that Dr. Robinson touched on in cotton. You're going to hear a lot of the same concerns and challenges and issues as we look at our grain markets. And I think the first reminder is there are two sides to a balance sheet. We're going to talk about tight supplies, some production issues that we're still unfolding here for the 2022 crop, but there's a demand side of the equation as well. And so there's real concern about what that might do moving forward and the price implications, particularly when you look at the global economy and the impact that can have on our grain market. So a lot of the same issues we dealt with in 2022. We've got high input prices, generally speaking, high prices for other crops. Now, again, it's interesting to note cotton relative to corn perhaps is changing some of those dynamics as we look at planting intentions for 2023. The same thing is starting to shape up in the soybean market. Corn relative to the soybean price is holding up a little more strongly. And so that may cause some implications for acreage decisions moving into 2023. Hopefully the drought situation is mitigating to some effect. I'll show the latest El Nino, La Nina outlook. We'll grab that slide right quick and stuck it in as well. So we'll kind of touch on some of these factors as we go forward. As with cotton, we've been on this upward path for a while now. These very high prices we've seen over the last 6 or 7 months, we've kind of been on this path going back to the fall of 2020. We then fell back in August, back to pre-Russian invasion of Ukraine levels, but even those are still relatively high prices. Now we've seen a resurgence in the grain markets here over the last several weeks, putting about $1 a bushel back on our cash markets. And that's reflected from a couple of things. One, on production. The other is the continued uncertainty and the challenges of some resolution of what's going on in that Black Sea area in terms of grain production, grain exports, and then other inputs, fertilizer exports coming out of that part of the world. As Ukraine is kind of this counteroffensive and retaking territory, what will the Russian response to that be, particularly when it comes to gas supplies this winter to Europe? Will they continue to allow those grain shipments across the Black Sea and that corridor that they've established? Will that fall apart as we go into October and November? It's all at risk right now. And certainly with the threat of energy embargo, that would certainly cripple the global economy to a large degree. And then the other actions that Russia appears to be taking in terms of trying to consolidate their control over some of the territory that they've gained, will now an invasion of their seized territories be seen as an invasion of Russia itself. Again, there seems to be a real escalation of some of the elements of this conflict that create a lot of uncertainty as we go through this winter of how this situation is going to be reconciled. The mantra through this entire growing season, starting back in February, we knew we had tight grain supplies going in, and this was the year that we can't lose acres and we can't lose yield. Well, that's kind of what we've done all season. We had a little hope maybe of a few higher acres when it got to July, but as Dr. Robinson mentioned, with the FSA numbers coming in and other survey data, our harvested acres continue to fall. Crop conditions have continued to deteriorate from the very first readings of this spring and summer. And so we're seeing our harvested acre estimates coming down, our yield estimates coming down. And that is reflected in these crop condition ratings. The blue dot would be an index generated from this portion of the crop that's rated very poor, poor, fair, good, and excellent. And you can see, of course, through the season, we've seen a growing number of acres in the very poor and poor category, and we're shrinking that good category. And so the index this year continuing to fall below and to a greater degree of magnitude below what would look like a normal reading. Let's zoom in on that just a little bit. This is what that looks like then if you look at the normal kind of index reading, and a trend line yield based on normal conditions this year would be about 178, 179 bushels per acre for a national yield. Back in July, USDA was projecting a yield of 177. You can see the condition rating starting to fall below average. That'd be 1% below trend. In August, 175.4. Now we're about 2% below trend as we continue to fall and widen that gap. In September, 172.5 bushels per acre. Now we're about 4% below trend. The last time we saw an index reading with this basic shape was back in 2011, and the final yield that year ended up being 6% below trend. If we were to settle at a 6% below trend this year, given these same kind of conditions, that would put the national yield at 168 bushels per acre. So we may not be done yet on adjusting this U.S. yield a little bit lower. And it's interesting, the Pro Farmer Crop Tour that was just concluded a couple of weeks ago, their national average yield that they projected for the U.S. was 168 bushels. So there seems to be, again, that we don't have that final number, I don't think, plugged in yet. And this situation may get tighter on the supply side. And so we're cutting that production number for the 22 crop down by some 415 million bushels at this point. That was what we lost for the last month, and we may not be done. But again, there is another side of the balance sheet. USDA also in that September WASDE, they cut feed use, they cut ethanol use, they cut exports. Now, we didn't cut it 400 million bushels to match the cut in production, but it does soften the blow somewhat with the lower production number, also impacting with high prices and global economic concerns, certainly impacting the demand side of the equation. What we're watching here is this days of use on hand. That's my stocks to use ratio. How long can we live next year on the crop that's left over from the previous year? Anything below that 40-day threshold is a really tight number for grain stocks. Here's the U.S. number. We're coming in about a 31, 32-day supply. That would be some of the lowest numbers. Go back to 2020, and then you're going back to 2013, 2012. This is a tight world to be in. You take the world without China. China holds about 2/3 of the world corn stocks. They're not going to trade those stocks. So what do we look like in terms of marketable corn? Yeah, it's about where we were a year ago, a little bit better perhaps than 2020, but still we're in this tight range. You go back again, 2013, 2012. By the time you see, again, world stocks without China as tight as they are right now. So certainly we're going to wrap up this year and head into 2023 with a very tight supply situation on the corn side. Again, to leave China in the equation, these numbers got inflated considerably a few years ago. China reset all their supply and demand numbers for corn, and that's why this whole data set from 2013 forward doesn't really match up with those years prior. There was, again, a reset of information that came out of China. And so I think looking without taking those into consideration maybe gives a little truer picture of what the price determining impact of that stocks to use ratio would be moving forward. And this kind of demonstrates that influence. Days of use on hand at the end of the marketing year, the bigger that pile of grain is, the downward pressure on prices. This is your season average farm price in the U.S. You tighten that supply up, and that's when you start to see these record high corn prices. And that 40-day thresholds seems to be key for this high degree of volatility and again, the higher prices that we're seeing. And we're in that ballpark right now. Probably some risk premium associated with the uncertainty still around the 2022 crop is why we're trading kind of above where the models would suggest that we may have a dollar of premium built into the market. But there's still a great deal of concern over just where we're going to end up this year because it's not settled in terms of the size of this crop and yet also, of course, on the demand side of the equation. But we're still in this area of relatively tight carryover and relatively high prices. And back to that same idea, when will that market start to turn the other way? When we start move back to that 40-day threshold, we got to have acres, we got to have yield. And I think until the market sees some evidence that we're moving back in that direction, I see a lot of firm support for corn prices this winter and early even into next spring until we start getting some better ideas on what those acreage and the weather and growing conditions look like for 2023. Talk about wheat for just a minute. Dr. Robinson mentioned the El Nino, La Nina outlook. We are currently continuing in the La Nina phenomenon, which is warmer and drier for the southern high plains. That situation is anticipated to get better as we go through the winter. And perhaps now by January, February, March, that time frame, that we could break out of this La Nina area and back into neutral conditions for this particular weather influencing phenomenon. So those sea surface temperatures starting to warm to some degree, creating more normal kind of growing conditions for the southern high plains, and moving back towards something closer to El Nino, perhaps by the time we get into the fall of 23. But at least break the current forecast is to break out of this current La Nina pattern by the time we get to January, February, March of 2023. And that may still be time to save a wheat crop and certainly put things in better shape for our spring planted crops for 2023 in the Southern High Plains. Talk just a little bit about wheat acres, and then we'll wrap this up. It's not uncommon to plant 6 million acres of wheat in the state of Texas. We don't always harvest near what we plant. In fact, we only harvest about half over the long term. And the notable feature of the 2022 crop is our planted acres got back up about 5.3 million, which is a pretty good number, but we're only harvested about a fourth of that. You have to go back to 2006 to find a year when we had such a low percent of planted wheat that actually saw a combine. What might be some factors that would influence our planted acres for wheat going into 2023? One is we've got record high prices in terms of the season average farm price for wheat. And since 2006, there is a positive correlation between the season farm price this year and the planted acres next year. And so this is setting that relationship between the price and planted acres in the state of Texas, that when we do see this move for higher prices in the previous year, we tend to see a positive influence on acres being planted. And so certainly I think with record high prices into this fall, I'm anticipating that would influence an increase in planted acres for wheat in the state of Texas as we move for the 2023 crop. Another piece touches on the cotton market. When you look at the cotton abandonment in Texas, again, go back to about 2006, those years of high abandonment, it opens up acreage in the fall for at least farmers to at least plant some wheat, maybe as a cover crop, see how things go. It doesn't mean it's going to see a combine, but at least it does create an opportunity, given some moisture conditions, that we might see an increase in acres, given the fact that we have such a crop loss in the previous year. And again, touching on very high abandonment acres coming out of 2022. Again, I think this would be, given this positive relationship, that's going to create the opportunity for more acres going into wheat. And so you can create just a very simple planted acres model for the state of Texas based on these kind of factors. And I think we're looking at planted acres in Texas of 5.8 million acres as we go into 2023. And that's, it's not the 6 million, which would be kind of a normal kind of number, but moving back to that area. I think the circumstances are such that we will see a significant increase in Texas wheat acres this fall. Again, a lot of that doesn't mean it's going to go to grain, but I think we will see kind of reestablishing that wheat base and wheat back into our production systems kind of seem to be shaping up that way. That's what I brought to share this morning. Again, I'll do the same. I'm going to hang around, take any comments or questions right now, and certainly anything as we get closer to wrapping up. Thanks again, Pancho, and good to be with y'all.
Thank you, Mark. Great information. Do anyone has any questions or wants to write them in the chat? Just write them in the chat and we will, answer them later. I do have, Mark, one quick question. We have seen
Sure.
and we heard a lot of, with these prices, how much land might be planted in other states that are not normally plant so much wheat.
Mm-hmm.
Are those acres might have a significant impact, or it's not an area that you think about? When we think about double cropping, you talk about ones and
Sure, and I am hearing more extension reports and publications around the profitability of double cropping, and there are many areas, particularly east of the Mississippi River, where they grow more of the soft wheat acres. That might be a profitable opportunity, and one may not be talking about a lot of acres, but we are talking about a part of the world that we can see soft wheat yields in that 80, 90, and 100 bushel range. So that could certainly make a difference. So I think more particularly in the soft wheat classification, but yet that would boost our wheat supplies. And so again, looking ahead to 2023, I think we're set up for higher acres nationally because of prices. And then as you start to add, even just on the margin, I think that can have a significant difference in terms of our production expectations for next year. So yeah, I think we're in shaping up for what could be a significant rebound in U.S. wheat production for 2023.
Thank you, Mark. David, you want to share your slides? Thank you.
Pancho, how's that look?
It looks great. Thank you very much. All yours.
Great. Hey, thanks for having me on today. Let's jump in. I'm gonna treat mostly cattle today, and I didn't put any slides for lamb or anything else this time. But let's jump right in. We can make this work here. There we go. Yeah. So cattle on feed report came out on Friday at 2 o'clock. And so I'm going to use a couple slides, just kind of chat about what's in there a little bit and kind of what that means a little bit longer term. I thought I'd start with the number of cattle that were marketed out of feedlots, meaning the fed steers and heifers that went to slaughter, was actually up just over 6%. I sort of joked around, some of y'all know I do pre-report estimates for Wall Street Journal, Reuters, folks like that. This is a month I get to brag. I often call that my monthly dose of humility, because you're putting out a pre-report estimate on a USDA report. This time I told people, well, I think USDA just took the month off and used mine, which just, every once in a while you hit it right. So anyway, fed cattle marketings were up 6%. There was one more slaughter day in the month just based on when weekends and holidays fall. But still, as we think about capacity utilization, lots of cattle on feed, we had no problem running this many head through. That's just over 2 million head went to market. That's a big number. Particularly, you'll notice that from July to August, it typically increases. It did this time to much greater effect. We moved a lot of cattle, which means in the month we produced a heck of a lot of beef. And so, in the midst of everything else going on, we're producing a lot of beef. And certainly the packing plants that we have now certainly seem to be able to handle the numbers that we have. If we take a look at daily average, sometimes I like to look to kind of sort out how many we're killing per day. And again, well above a year ago. That dotted line is last year. The red line is on average, and above average marketings in terms of daily average. So when people talk about, do we have a backlog? Do we have a hole developing in the market that may lead to some better prices here in the short term? We're certainly moving a lot of cattle. Placements. This was the one that as typically in the pre-report estimates, the most uncertain. Placements were actually a little bit higher than a year ago, just about 8,000 head higher than a year ago. That's a lot of placements, and we are seasonally on the upturn when we're starting to get more yearlings from those kinds of programs in parts of the country, more calf placed from other parts of the country as well, but certainly placements were higher as well, which lots of placements, lots of cattle on feed. Again, as it has been for about 4 months now, the bulk of the placements were under 700 pounds in weight. So we're placing lighter weight animals, and that's really drought driven. If I went back to these placements for just a second, placements in Texas were up. Let me look at my notes here. Placements in Texas were up 9% year over year. So we placed a lot of cattle, and almost all the increase in placements were under 600 pounds. So a lot of lightweight animals, really drought forced placements of calves going to market and heading to feedlots. So again, those animals are going to be on feed a long time. So they'll be well into next year before they finish. But again, 4 months straight of lightweight animals going on feed, even in the face of Mark Welch's high corn prices, high feed costs, we're still putting animals in feedlots. So total cattle on feed ended up just barely above a year ago. I think just 100.4%, pretty close to a year ago, but still ahead. And again, what we're doing is we're placing now animals that we would have placed in the future. So we're pulling those animals into feedlots ahead of time. It's keeping our cattle on feed numbers high, but sooner or later we run out of animals to place. And so, I certainly expect, the expectation is that we're going to start seeing fewer cattle on feed, maybe even later this year, and it's certainly into next year as it reflects fewer cows. And once we pull those animals on feed, they're not available to place later. So I think this is something that's, I think pretty interesting in the cattle market. I talked about how large marketings were out of feedlots in August. If we take a look at the number of heifers that we're slaughtering, particularly the last couple of months, that's a big year-over-year change. In fact, while steer slaughter's been down, heifer slaughter's higher. So when we think about more beef production compared to a year ago, that production is really coming from more heifers and fewer cows. And that's how we make the herd smaller as well. So we've certainly got that going on. It shows up in the data very clearly. This big decline in the last week of data really reflects Labor Day week. So again, there's a lot of heifers going to market that aren't being held back. They've gone to feedlots. Beef cow slaughter. I had thought that maybe with those rains, some wishful thinking, with the rains we saw last month, maybe that held some more cows in the country. We might see a little bit decline in cow slaughter. Boy, it sure doesn't show up in the national data in terms of the number of cows going to market. We continue to, every week, slaughter more beef cows than we did the week before. Kind of put this in perspective a little bit. I decided to compare versus 2011. So I'm going to look over here at my notes. We've so far nationally, we've slaughtered 180,000 more beef cows than we did last year, than we did in 2011. So if we think about Region 6, which includes Texas, the cow slaughter data is released by region. Region 6 includes Texas, New Mexico, Oklahoma, Arkansas, and Louisiana. So far this year, we've slaughtered 738,000 beef cows, well ahead of a year ago. But in 2011, to this point, we had slaughtered 762,000. So in our region, we're actually running a little bit behind 2011, which has really occurred just in the last month. Because when I looked last month, 4 weeks ago, in fact, we were about 8,000 head ahead of 2011. So, they're in the region, there is a little bit, maybe we did slow down some beef cow slaughter a little bit. I think that what's more important is we have fewer beef cows in 2022 than we had at the beginning of 2011. And so beef cow slaughter as a percent of the cow herd, both in this region and in Texas, we're slaughtering a larger percent of the beef cow inventory. So as we think about, cow herd for next year, well, we're sending a lot of cows to market. We're holding back fewer heifers, and I think we ought to be prepared for pretty substantial decline in the number of beef cows. And both Mark and John talked about La Nina, continued drought prospects, and this is going to keep hitting us pretty hard, I think, on the cow slide, on the cow side of things, the beef cow side of things as well. So, I think both those are important to look at. Let me point out a couple price charts. One is just 500 to 600 pound number one steers. This last little run up in corn prices, I think, has taken some out of the calf market the last month. We actually got over $2 a pound. On average, we're back down under 190 over the last 4 weeks. And so, really, if we look over the last couple of months in the face of lots of animals going to market and some higher corn prices, we see both the ups and downs in the cattle market. I might compare to a year ago, and we have prices well above where we were a year ago, even in the face of much higher feed costs and drought-forced sales of calves. That we still have these higher prices going on. I think this is my last slide, but we'll know in a second. I thought I would point out one thing about the wholesale market. So as we think of beef demand, our customers' budgets, high costs for everything else, what's going on with demand, also in the face of some really large beef production that I highlighted in heifer slaughter. We see the wholesale beef market is shown by the cutout value. That cutout value was down to about, I think it was 150 and change last week. That's the lowest wholesale beef price in a year and a half. You got to go back to the first week of April of 2021 to get to lower cutout values. So I think a wholesale beef, are we going to start seeing some lower beef prices at the grocery store reflected because of this large production? I think we're going to. I think one of the things we're going to see is this cutout value that's at this level. My expectation is that we'll probably see some lower retail prices as well, more reflective of these lower wholesale values compared to a year ago. If I'd have pulled some cuts, whether we're talking ribeyes, New York strips, ground beef, lean beef going into ground beef, across all of these cuts, we've got lower prices in the wholesale market than we did a year ago. I think that's where the potential is for some lower retail prices as well. But again, these lower wholesale values, where we're going with this over the next not only few months, but the next couple of years, with less beef production because our cow herd is smaller, we're going to get higher cattle prices. Yet we're going to see resistance on the retail side just from customers aren't going to spend that much. They're going to shift what they buy in the meat case. And I think the pressure is going to be on both retailers and meat packers in terms of margins going forward. So I think that's something we'll see over the next couple of years. But that we have the lowest wholesale beef prices in a year and a half, I think, is a pretty significant kind of statistic in the cattle market. That should be my last slide. Yeah. Let's see. Stop sharing if I can figure out how. There we go, Pancho. How's that?
Excellent, David. Thank you very much. Anyone has any question for David, Dawn, or Mark?
Hey, David,
Yeah.
I was just gonna ask real quick, what are the futures kind of, I know that's a highly loaded question depending on if it rains or whatnot, but what are the futures kind of showing for, cattle, say, right after the first of the year? I mean, we got guys running around here telling them, hey, hold off as long as you can. We're going to see $1,500 yearlings again.
So generally, the futures market is showing cattle prices next year that are higher than they were this year. From a fundamental kind of cash market, I have prices higher next year than this year across every quarter of the year. Some of those prices, those 750-pound steers, depending on what market you're in, they were pushing $2 or better at times this year. So that's close to $1,500 per head. I think I would argue over the next couple of years, we're going to be back to talking about record high calf prices. So if we think about 14 and 15 as being record high calf prices, I think we're going to exceed those. And we're going to exceed those because we're going to have fewer cows, less calves for sale, less beef production, and high prices. But the way we got those record high calf prices was the drought broke and folks tried to restock. And so we were chasing a limited number of heifers for replacement. That's what really drove those prices that high. So I don't think we're quite to that point yet because I don't think we have any drought relief going on. And so, I'm not sure, in terms of holding off selling or whatever, I think that's fine if as a strategy, I think that's fine if you have the grass. I would be probably more interested in holding my grass for my cows, any replacements that I have, so that I have calves to sell down the road when those prices are even higher. And that was one of our problems that, following the drought of a decade ago, is folks didn't have anything to sell. We had to sell off our herds so deeply. So I think strategies of like holding on to females may be a little better strategy than some of the other stuff around. Did that answer that question?
Yes, sir. Thank you.
Yeah, the other thing I think too is that we're going to see in calf prices over the next couple of months is really related to Mark's. How many wheat acres are we going to plant, and are we going to have any rain to get the stuff up for grazing? And, you know, whether it's wheat a little further north or oats down closer this way, I mean, to me, that's a big question because we get a lot of demand for calves for winter small grain pasture grazing. And, you know, if we don't have much of a crop of that grazing coming up, we're going to have a lot less demand for calves. And so we're stuck hanging on to them, or they're going to go to feedlots, which keeps those placements and cattle on feed numbers high, but just because they're not going to small grain grazing. So, you know, I think that's, to me, that's the big risk in kind of the cash calf market over the next couple of years, or excuse me, next couple of months, is what happens with wheat pasture. And it looks sort of grim right now to me. Pancho, you and Mark may weigh in on that, but dang, it looks pretty tough.
I think it's non-existent up here around me and Poncho. I mean, it's not going to happen. I mean, we got guys they hadn't even started sowing, and they usually have wheat up by now. So, and it's supposed to be like it was 99 degrees yesterday. So, I mean, it's not going to work.
Yeah, I would agree. I mean, by now, gosh, you know, what grazing are we going to get, you know, with plantings this late? And if you did have some, you know, there might be more people interested in keeping their cows on it than running stockers just as a feed resource for the cows. Yeah, I think yesterday, we were 97, 98 here in College Station, something like that. I mean, it's hot and dry.
That's great. Hey, any more questions for David, Mark, or John? Well, John, Mark, David, thank you very much for being here. Really appreciate. Thank you everyone for being here. One more thing before we close, I'm going to leave kind of a little survey just to check a little things about what's going on in every county and slash evaluation thing on the chat. You know better than we do, you know how those things work. So, you know, I would really appreciate if you can answer that. Hey, thank you everyone. We're looking forward to see you all next month. Okay, thank you.
Thanks, guys.
Appreciate it. Y'all take care.
Thank you.